Advanced Financial Modeling, Topic 10, Capital Budgeting, Learning Objective number 7. We're going to evaluate several other investments for capital budgeting. First one is Walmart launches in-store banks. In this example, Walmart is considering the launch of banks inside every superstore. So the following worksheet is going to work through the annual free cash flows, NPV, and IRR of the investment. I want to point out that this is an infinite life investment, or in other words, we'll call it an ongoing concern. So I'm not going to have a finite period of time. However, I can't have an infinite spreadsheet, so I need to finish off the valuation using a growth perpetuity or an EBITDA multiple. So we're going to show the NPV. So here is the spreadsheet. Let's jump over. So here are the assumptions. We're going to spend $550,000 today, depreciate it for 10 years. The banking revenues are going to be $200,000 a year starting year 2. Banking COGS are going to be 60% of revenues, and there's going to be no SG&A, so we just consider that a combination of COGS and SG&A. Net working capital is going to be 20% of the next year's sales. The lost store EBIT. So this is the idea that if we take some store space away from regular Walmart merchandise, they're going to lose $50,000 a year, and that's already an EBIT. So that's revenue minus your COGS. However, we're going to have an extra add-on sales of $40,000 per year per store because there'll be more people showing up, say on payday, to cash their checks. We'll use a tax rate of 25%. All sales grow at 10% per year for years 3 through 6. And then we'll finish up our evaluation in year 7 and assume that free cash flows grow at 7%. I'm sorry, from year 7 to infinity at 1% forever and a discount rate of 8%. So in this example, we have our revenues of $220,000 growing at 10% a year. And I took that out to year 7. Even though I'm going to finish my evaluation actually in year 6, but I need this for working capital. I have COGS of 60% of sales. I have depreciation of the $550,000 depreciated over 10 years. Again, I'm only using a 6-year window for valuation, and then I'm going to use a growth perpetuity, but I'm still depreciating it over the 10-year life. Lost store EBIT, it's going to lose $50,000 a year due to lost sales from less merchandise for Walmart, but an extra $40,000 from people spending more money in the stores because maybe they do banking there. So I add all those together, and it's going to be an EBIT of $15,000 to $47,000 a year. I take EBIT after tax. I then add back depreciation. I subtract out the CapEx at period 0. There is no residual. So this is common for an ongoing concern or an infinite life project. And in this case, we're going to spend $550,000, but we're not going to have a residual here because it's going to be used, say, forever, or at least close enough to forever. I'm going to need $40,000 of working capital. Now, where does that come from? There's an assumption that it's 10% of the next year's sales. So that net working capitals go from 0 to 40,000 in the first year. That's why it shows up as a negative from 0 to 40,000. That's period 0. And then it's going to grow. And so this is the minus the change in net working capital. And notice I didn't take the net working capital to 0 at year 6 because, again, it's an ongoing concern. You can't just sell off all the inventory and close all the receivables and payables down. Now, these are the free cash flows for years 1, 2, 3, 4, 5, 6. And then this accounts for the value of those cash flows if they continue from year 7 to infinity. Notice the formula there. It's the cash flow in year 6 right here times 1 plus the perpetual growth rate of 1%. That is the cash flow in year 7. And then when I divide by R minus G, that gives me the value of cash flows from year 7 till infinity, the year before they start. So that's year 6. So I can add that year 7 perpetuity that's valued in year 6 together with the year 6 cash flow. And I have now my free cash flows plus terminal value. I can now value this project by taking the NPV at 8%, discounting the cash flows. Remember to skip that period 0 cash flow and then add it back later. And then I have an IRR. Now notice I didn't use the IRR function because I need to tell you something. whenever you have a growth perpetuity and a valuation, you cannot use the IRR function, because the IRR function gets confused when to apply that discount rate, that perpetual growth rate and discount rate in the denominator here versus just regular discounting here. So whenever you have that situation where you have a growth perpetuity, to calculate IRR, you have to do data, what if, goal seek, set that NPV to 0 by changing this discount rate, hit OK, and this number will change to 13.95%. So you want to set this NPV to 0 by changing that discount rate that's linked to that NPV. And notice that goes to 13.95. I'll hit cancel and I'll type in 13.95 there. One other thing I want to show you with this valuation, you have to always be careful when you talk about infinite life projects or projects that have these growth perpetuities in it. And that is this project, this bank, it spends the $590,000 here total investment to outfit the bank and get the working capital. However, there's no new contributions to working capital. So as computers are wearing out, they're not being replaced. There's no new safe after 5 or 10 or 20 years. So I'm a little concerned doing this valuation that this building here, this bank within Walmart is going to start deteriorating. So one trick could be that final year, I might throw in another CapEx. And that might be that last year's depreciation. So I'm going to say, you know what, I'm going to put $50,000, $55,000 a year to upkeep the building. And when you do that, you can see what it does to the NPV. It actually turns it negative. So that's a really question you need to ask yourself. If you have an infinite life project, are you adding to the capital stock? Are you adding assets or replacing assets? Another common thing that you might want to do is take some percentage of revenues or some percentage of CapEx and put it in OpEx and just have another OpEx line here and call it maintenance of equipment and computers and make it maybe 10% of sales. So you have some monies allocated to upkeeping the equipment or assets. All right. The next one we're going to value is this. You're going to launch a monthly digital marketing plan. It's OpEx only. So you're considering the launch of a 1-year digital marketing plan. And the spreadsheet has the assumptions right here. We'll go to the spreadsheet. So that plan is going to cost you to develop the content. It's going to be $30,000 a month for the next 2 months. That shows up here as planning expense. We'll just call it, well, these are operational expenditures. They're not going to be, we'll assume they're not depreciated. And then once you launch the ad campaigns from months 3 through 14 for 1 year, it's going to cost you $25,000 a year, per month for, say, ad spend. That's who you pay for Google and Facebook and the rest of them. Then it's expected to generate $40,000 per month. And the cost to produce those goods are going to be 30%. So the cost of that $40,000 is $12,000. So now we have the EBIT for the next 14 months. I'm going to lose $30,000 as I develop the content and pay the vendor. And then I'm going to make $3,000 a month for the next 12 months. I take that after tax. And then I have an assumption on working capital. When I start selling, I'm going to need some percentage of sales. So I'm going to need 1 month's inventory, in sales. 1 month's sales and inventory. So I'm going to assume if I'm going to sell 40,000 of these, whatever these are, in month 1, I'm going to need 40,000 inventory the month prior. I'll put that in there, but I'll add it back at the end because this is a finite life project. It's not going on forever. And then we can calculate the NPV. Now, since this project's monthly, notice I'll take my discount rate, A8, 15%, and I'll divide it by 12. That'll be a 1 month discount rate. And then I put in the monthly cash flows, which are just right there in column I. So it has an NPV of losing $25,000, so maybe you shouldn't do it. And I calculate the IRR. If I take the IRR and use the free cash flows in in column I, you see I have to multiply times 12 because if I have monthly cash flows, this is a monthly return. So I need to multiply times 12 and it's minus 27%. So, but there is a reason why you still might want to do this. What if you do a sensitivity analysis? That 95% of the time, these are the cash flows. 95% of the time, these are the cash flows. But 10% of the time, this ad campaign goes viral and we don't get 40,000, we get 400,000. And when you do that, you get these cash flows that have an NPV of $1.9 million. So how can I now think about whether I should do this? Well, I guess I'm using 95%. There's a 95% chance I'll lose $25,000, but there's a 5% chance it goes viral, and that NPV using $400,000 revenues is 1.9 million. So 95% of 25,000 loss and 5% of a $2 million gain, I get a weighted average or a risk adjusted NPV of $74,000. So therefore I should do it, even though 95% of the time I'm going to lose. All right, last example here is a buy or lease situation. The business needs a computer, it's going to buy it or lease it. If it buys it, it costs $4,000 today, and it's going to be depreciated over 3 years. If it leases it, it's going to make 4 payments of $1,500 lease expenses. These are operating leases, so you record them in the year in which they're incurred. You don't put it to the balance sheet. And these are 4 payments. There's one due period 0 today, $1,500, and at the end of the first year, second year, and third year. So what I'm going to do is to calculate the NPV of whether I purchase or lease the equipment. And I'll show the spreadsheet, and I want to go back to this spreadsheet here showing long form versus shortcut free cash flows. So what I'll do is I'll go to the purchase lease. Here are my assumptions. If I purchase the equipment, I'll spend $4,000 today. Now, here are my free cash flows. Remember how to get to FCFFs? You get EBIT after tax, subtract CapEx, add back depreciation. There's no working capital in this example, and you get your free cash flows. So I spend $4,000 today. Notice I have no sales or COGS or SG&A. I just have depreciation. So my EBIT is negative. It's just depreciation. I take out taxes, and then I have EBIT after taxes. I'm going to add back depreciation, and I get a free cash flow of $533. I take the NPV of those cash flows, and it's negative $2.649 million. Notice these cash flows are the same as these cash flows. But let me show you a shorter way to do this. You don't always have to reconstruct an income statement to get EBIT after tax and then do the add depreciation, subtract changes in net working capital, and subtract CapEx and add residual. You don't have to do that because this is pretty easy to keep in your head. So here's what I'm going to do, and here's how I want to show this slide. Here's what we've done so far. The long form, and here's the example where you only have depreciation expense. But what I did is I created an income statement to show revenue minus COGS minus SG&A minus depreciation equals EBIT. But our example here only had depreciation. I then take out taxes. I get EBIT after tax. I add back depreciation, subtract CapEx, add back salvage or resale, minus changes in net worth. And so this is what I did in the last example, except there is no COGS, there is no SG&A, there are no sales. But let me show you a shortcut way. What if remember why we subtract depreciation and add it back. We subtract it because the IRS recognizes it as an expense. So we subtract it to calculate the true tax, but then we add it back because we recognize that it has no actual expense. It's not a cash expense. But what if we just take care of the taxes at each step and don't worry about the full income statement? In other words, I could just take the after-tax revenue or maybe savings if you're saving some expense. Or I could just take the after-tax COGS and subtract the after-tax tax rate. I can then subtract depreciation. That gives me EBIT, I call it EBIT after tax, earnings before interest, tax, depreciation. All right, so now actually notice I skipped depreciation. So if I skip depreciation at this step and just take after-tax sales or savings, after-tax COGS, and after-tax SG&A, we'll call that EBITDA after tax because I haven't dealt with depreciation. It's earnings before interest, tax, and depreciation. Then all I need to do is handle the tax effect of the depreciation in one step. And that is the tax shield created from depreciation expense is simply depreciation times the tax rate. So back to my spreadsheet. I could do the full income statement here and then make the adjustments for depreciation, CapEx, and working capital. But I could recognize that in this case, my only cash flow initially is CapEx. And then the only other cash flow is the depreciation tax shield. Depreciation tax shield is just the depreciation amount, that $4,000 divided by 3 years times my 40%. And those are the savings. So notice I could just do it this way. My CapEx, my depreciation tax shields, there's my total cash flows. Those are the same as these cash flows here. It's a lot simpler. And then what about the lease? Well, in this case, the lease is going to be $1,200 per year starting today. If I did a full income statement, my EBIT is losing $1,200 per period. I then take the taxes out. That creates a tax shield. And so after tax, it only cost me $720, right? The idea of the tax shield is that by having only a loss here in these periods, I'm going to shield the rest of the corporation from paying taxes because we assume the rest of the corporation is profitable. And so the after-tax cash flows are $720. But I could do a short method. And that is, since these $1,200 are just OPEX, I can just take the after-tax OPEX and go directly, since those are the only cash flows, go call those the only free cash flows that matter. So initially, you're going to want to always do the full income statement and balance sheet, even if you don't have all the items. But at some point, you'll get tired of that and realize that this does not have to be done, especially in this case. All there is one OPEX. I could just take the after-tax OPEX and be done. So in this case, in NPV terms, I need to have this computer, and in present value terms, the lease is lower negative number than the purchase. I need the computer, therefore I will do the lease. All right, next topic, we'll talk about equivalent annual cash flows.